By qualification, I did MBBS as graduation. I finished it in 2005. After that, I worked for a few years in medical field as a clinician doctor. And then from 2009 to 2011, I did MBA in finance from Indian Institute of Foreign Trade, New Delhi, which is a tier A school in India. I got gold medal there for being at the top of my class, and alongside MBA finance, I completed all three exams of CFA Institute USA. Alongside that, financial risk management course from CAR Institute, that again USA. I completed MBA in finance in 2011, and after that I worked for around 5.5 years in ICICI Bank in credit risk management group, where I was covering real estate sector. And since last 1 year, November was the month last year when I quit my job, and since last 1 year I am a full-time investor, blogger, entrepreneur, whatever you call it, and alongside that we hold workshops to elaborate our investment philosophy, which is peaceful investing. There are multiple ways in which people invest into stock markets. There is no one way which is the right way. There are people who go for growth investing, there are people who go for value investing, there are people who go for fundamental investing, technical investing, there are people who follow arbitrage, looking for arbitrage opportunities, etc., etc. So there are so many people following so many different approaches to make money into markets, and those who follow any approach consistently, there have been cases that investors, traders have been successful in following their own approach. So we advise that rather than limiting oneself to a particular approach at initial phases of investing career, people should try out different approaches and try to find out what is the approach which suits them. Like when we started equity investing since about 10-11 years back, I started it by following technical investing. So I used to look at charts, stop loss and trends, etc. So from there, within around 1.5-2 years, I realized that this is not working for me. I need something else. Luckily, I got introduced to the book called Intelligent Investor from Benjamin Graham, and from there I realized that fundamental investing is something which I associate more with. And from that day, about 8-9 years back, I am following fundamental investing. And peaceful investing is something which the fundamental investing which we started following around 8-9 years back, how it has evolved over the years. And let me tell you, throughout the journey in which this investing approach evolved, I was always doing something full time which was, say, not related to investing. Either I was preparing for my MBA entrance examinations, or I was doing MBA, or I was doing a full-time job in a private sector bank, which is a 9-to-9 job. So all the common challenges which are faced by any part-time investor, retail investor, the primary challenge which is faced by them is lack of time. So all those challenges have been faced by us, and then this approach, it got evolved over the time. So what we have seen is it has worked well for us, and depending upon the feedback which we received from the participants of previous workshops, part-time investors specifically have found it quite useful. So what we believe is there are multiple, like we say, all roads lead to Rome. So there are multiple ways to make money in the markets. A person should find out what is the approach that resonates more with the personality, time constraints, etc., which are particular to a person, and then follow that approach. But what we believe is that there is one key requirement from equity investors. If the significant amount of wealth is to be made from stock markets, when we read about different success stories of investors who have made significant amount of wealth in equity markets, to realize the true potential. So one particular common theme comes out of all those studies is that one has to stay invested all around 33 lakh. So in 26 years, money would have grown 33 times, depicting a rate of around 14.5% annualized returns. But out of these, around 9,500 days in those 26 years, if because of any reason the investor would have missed 10 best days and remain invested for 9,490 days, the final return would have not been 33 times, it would have been only 12 times. And instead of 14.5%, the return would be around 10%. And if, God forbid, instead of 10, somebody misses out 20 days, the return would only be 7.2% per annum. And if somebody misses out 30 days, it would be 4.75. If somebody misses out 40 days, the return would only be 2.54% per annum, which is even less than a savings bank account interest rate. So it is crucial for any investor to benefit from these days which give the maximum return. So you take 9,500 days, whatever are the trading days, 5 days a week out of these, arrange them across days from highest return on the days on which Sensex increased the highest, and in the decreasing order. Let's say on one particular day Sensex increased by about 15%, which was in 2009 after UPA 2 came into election. So you, because of any reason, if you miss that day, that is counted as one day. So out of 9,500 odd days, if you miss out these few days, the return falls drastically. And this is a 26-year time horizon for Indian market. The studies, the results remain the same, whether we reduce it to 10 years in Indian markets or even increase it to 80 years in US markets. So the critical message which I want to give to you is that to make real wealth from equity markets, one has to stay invested, both on good days as well as bad days. And the way markets behave, most of the times the good days and the bad days, they are clumped together. You would see that market has fallen if a stock has fallen 10% today, probably next day it might rise back 7% or 8%. So it becomes extremely difficult to judge with perfection when a best day would come. What we believe is it's impossible. But we need to benefit from those days when maximum returns come, and to absolutely benefit from 100% of those days, there is only one way: to be there all the time. So there is one key point which I want to communicate to you is that one needs to stay invested all the time. But there is another aspect also. What is that aspect? Volatility of stock prices. What does this mean? If you see from any particular date, say today it is November 26th, previous 52 years, all the stock exchanges, financial websites, they depict what is 52-week high price, what is 52-week low price. And most of the times you will notice that 52-week high price is almost double of the 52-week low price. Whereas if you consider over a period of 1 year, most of the times the dynamics of the business of a company, they remain fairly stable. So despite the fundamentals remaining stable, there is very high probability that even going ahead in next 52 weeks, the stock price can double or it can become half without any change in the fundamentals of the company. So now there is very high probability that if we have invested say rupee 10 lakh in a particular stock, rest assured, if not today, tomorrow, the time would come that the company would be doing its business in the most normal way, in the most expected way, but the stock market would reduce its stock price by half, and the 10 lakh which we have invested in a stock in a particular day would become 5 lakh over the duration of next 1 year without any change in fundamentals of the company. So this chance of money reducing by half, portfolio size reducing by half without any change in fundamentals, and marrying it with the intention of staying invested all the time for multiple years, that brings out the best or the worst of behavior from equity investors. We need to be able to digest volatility if we wish to if we wish to depict the absolutely needed behavior from equity investors, which is stay invested all the time to generate the kind of wealth which equity markets make for all of us. And to have that confidence in the stocks which are there in our portfolio and to stay invested despite stock price declining by 50%, we need that each and every investor should analyze those stocks on their own, because that confidence when stock market is hammering the stock price, then to stay away from the crowd which is reducing the stock price and taking an independent view, not looking at the stock price, only looking at how my company is performing, how is the business doing. To take this differentiated view from the crowd, one needs to have done that homework while selecting the stock, so that the person can have utter confidence in his or her hard work, and then realize that yes, whatever stock market is doing, I do not agree with that. The company is doing as good as it was earlier, and now because the stock is available at 50% price than it was available earlier, this is a sale of a fundamentally sound product and let me buy more of it. So the desired behavior from equity investors that stay invested all the times, and whenever such volatile times come that the company is fundamentally sound but the price is reducing, then instead of selling out, be cool and calm and invest more money into the markets. That behavior is something which we have seen. The stocks which are selected by following the principles of peaceful investing, those stocks, they give such kind of confidence to investors. So here comes the role of peaceful investing as an approach, and we would spend entire day discussing about stocks, parameters, what are the preferable factors which we should look into stocks, etc., so that we are able to find out those companies which are fundamentally so sound that when tough times come, then those companies have got very high probability of coming those tough phases, those business down cycles, etc. And we still witnessing that decline in our own portfolio, we still remain calm in our behavior and we sleep peacefully. So throughout the discussion of the day, at the end we will come out with certain parameters, and let me give you those parameters right at the start, because we will keep on reflecting to these parameters, these 5 commandants which we call 5 pillars of peaceful investing, that the stocks which have got very high probability of fulfilling our desired analysis parameters and giving us stocks which are fundamentally sound, those 5 parameters which we will keep on referring again and again during the day, that if a company has got these 5 parameters, there is very high probability that these companies will maintain their earnings growth in future despite facing troubles, and market has got a habit of rewarding such companies. So first thing first, we will write down these 5 parameters and we will keep coming back to them time and again throughout the discussion of the day. So what are those 5 parameters which fulfill the peaceful investing filters? So the first is that the company should be growing. So by growth we mean sales growth. Second is that these companies are profitable, and not just profitable, that profitability is sustained or improving. Third is these companies are profitable and those profits are getting converted into cash, and the amount of cash which these companies are making, that cash is more than sufficient to meet all the operational expense requirements as well as the capital expense requirement of the company to fund its future growth, and there is still some surplus left which it can freely distribute to equity shareholders as dividends or buyback shares, etc. So the amount of cash which it generates is more than the requirement of cash in its operations as well as to fund its growth in terms of capital expenditure. So in effect they have got free cash flow. And when a company has so much of cash generating ability which is more than enough to meet its operational as well as capital expense requirement, then you would find that In normal course of business, these companies do not require to take additional money from bankers, etc., because they are able to fund everything from their own. So you would find that these companies are conservatively financed. By conservatively financed, we means very low debt to equity ratio or almost a debt free status. And then the final parameter, which is the most important one, which is management. So if you find that there is a company which has got excellent business, excellent cash generating ability, but somehow it is being run by somebody who is over smart, rest assured the person would find all the ways to take money out of the company. A good business in the hands of over smart promoter at the end of the day ends up not creating any wealth for people other than promoters. So it becomes essential that when we have done so much of hard work to find companies which meet all four of the parameters, then it becomes crucial that the fifth parameter, which is management, is necessarily fulfilled. Otherwise, all the hard work to find out companies which meet initial four parameters, if this fifth parameter is not satisfactory, all the hard work might go into vain. So these 5 pillars of peaceful investing we will keep on referring to again and again. So with this, let us start the journey of the day, which is to find out stocks which meet these parameters. What we have seen is the participants of any peaceful investing workshop, they vary by the way of their education backgrounds as well as experience into the markets. So it becomes essential so that we understand a brief about how many people sitting here, they are from a non-finance background. So when I say non-finance backgrounds, means people who are not CAs, who are not MBA in finance, or who have not taken formal education in finance. So what I see is around 20-25. So it is roughly around 50% people from non-finance background. And also people differ in the way, in their experience into stock markets. So how many of the people sitting here have got experience of less than 2 years investing into the markets? So around 15-20, yes. And how many of you have got 2 to 5 years of experience? Okay, and more than 5 years? More than 5 years. So there is fairly mix of the representation here. So around 50% of the people are from non-finance background, and roughly around 20 odd people are the ones who have got less than 2 years of experience. So we will take that aspect in care when we delve into discussion how much depth to go. When we analyze any stock, what we have seen is it helps if we take a structured approach towards it. So those who have been following our website since long, so you would know that we divide our stock analysis into 4 different aspects. So those 4 aspects are: one is financial, second is business, third is valuation, and fourth is the most important, management. Analyzing a stock from these different aspects, it equates analysis of a stock just like analysis of a human being. So when we have to make an opinion about any human being, we look different aspects of the personality of a person, including the outward physical appearance, how he looks, how he dresses, including the behavioral aspects, how he treats his peers, seniors, juniors, what is the educational background, from where he has studied, what is the education, as well as what kind of family he comes from, etc., etc. So there are multiple approaches, multiple aspects. We look at these aspects and then we come out with a final conclusion about how much weightage we want to give to that person in our life. We want to make him a good friend or just an acquaintance, etc. Similarly, these 4 are the aspects of analysis: stock analysis, financial analysis, business analysis, valuation analysis, and management analysis. So these 4 different aspects, we analyze a stock from all these aspects and then we come out with a with a comprehensive view about whether a stock is investment worthy or not. So many times we get such queries that if a company is financially very good profitability, very good sales growth, should we invest in that? Only looking at financial will not lead us to an investment decision. We need to see whether it is in a good valuation band, which has got higher probability of giving us returns in future, and whether it is being run by a good shareholder friendly management. Many times queries get asked, a company is available at a very low PE ratio, let's say PE ratio of 1, should we invest into that? We need to analyze whether it is financially sound. So does this company is a discount at PE ratio of 1, or it deserves a PE ratio of 1? So that we would come to know when we will analyze financials. Also management, is there some concern related to management? Has the management taken out money from the company out in the past? Or the management is already facing some SEBI inquiry, etc. for cheating investors? So if all these things need to be taken into account, only then we would be able to come out with the final conclusion that whether any stock it is investment worthy or not. Just like analyzing a human. So while making a final decision about investment attractiveness of any company, we need to analyze it completely on all the 4 aspects and then make our final view whether we need to go ahead with that or not. So we would see that to analyze a stock on all the 4 parameters, we first need to identify which stock we need to spend that time on. Because there are more than 5,000-6,000 stocks which are listed on Indian stock markets. Not all of them are actively traded. Maybe monthly basis, if you see 2,500 would be the stocks which get traded at all. Rest 3,000 odd stocks might not get traded. So out of those 2,500 stocks which get traded, do we want to analyze all of them and then come out with, okay, this is the best stocks out of these 2,500 stocks that I would want to invest? Do we want to spend this amount of time on all 2,000? Probably no. So everybody has got a way of shortlisting stocks. This shortlisting of stocks is called idea generation. And like I said, there are multiple ways in which people approach or invest into markets. Similarly, there are multiple ways in which people shortlist stocks for their investment, for spending time to analyze stocks for investments. There are many people who do primary research. They go to malls, etc., stand in front of shops and try to see which are the brands, consumer brands, which are witnessing maximum sales and whether the company is listed. If the company is listed, then go back home and try to analyze financials, etc., put it under all these checks and try to see whether you would want to invest in it. So that is one aspect. Second is many investors, they let's suppose they appreciate some author in a magazine. So if a magazine has covered a particular stocks and the author has given good reviews, then probably that becomes another point from where the investor will pick that stock and put it under scrutiny. So similarly, everybody has got different ways of shortlisting stocks. We have our own way. I'll elaborate that. So there is no way which is absolutely right or there is no way which is absolutely wrong. It all depends on how much time, etc., you have with you. If you have time to do primary research, exceedingly well. Because that way you might come out with such information which is not yet there in the market. People do not know. You might be the first one to capitalize on that. So depending upon how much time you have with you, depending upon how much skill set you have, if you have got good people relationship skills, etc., then you can simply call up people in the companies or competitors to a particular company and then try to take market feedback. So all depends on personality of a person. What we do is, there is an excellent website which is screener.in.